for setting this all up. Just by way of very brief introduction, many of the people on the call may have attended other of our summer series of events already and be familiar with the format. But just by way of introduction, my name's Tilly Franklin. I'm the founder of GAIN, which, as I'm sure you all know, is a charity that aims to attract more young women into careers in investment management. And I'm also the Chief Investment Officer at the Cambridge University Endowment Fund, which manages the investment assets of the university to generate income to help fund teaching and research. So the format for today is that I'm going to ask our wonderful panelists to introduce themselves, and then we'll plunge into the topic of hedge fund and multi-asset investing. We'll cover aspects of the asset classes and investment styles themselves, and we'll also try to talk a bit about everybody's individual sort of journey into investment management. Before we kick off, I'd just like to really thank our panelists for giving up their time to be here today, and I'm really looking forward to the discussion. I'm sure it'll be fascinating. So without further ado, maybe I can just ask each of you to just introduce yourselves and tell us a little bit about what you do specifically and how it relates to hedge fund and multi-asset investing. Maybe we can start with Caroline, if that's okay.
Thank you, Tilly. I am Caroline Shaw. I'm Head of Asset Management at Courtiers Asset Management in Henley-on-Thames. We are a wealth management firm with an asset management firm embedded within it. I'm managing or co-manager of 3 multi-asset funds with about 700 million under management, and our client base is largely private client and institutional DB pension schemes. We run our multi-asset funds with a risk-based approach, and we can invest globally and in any asset class.
Okay, it sounds like quite a remit. Given that I think that your roles are slightly analogous, maybe Mona, you'd like to go next, and then we'll move on to Louise.
Hi everybody, I'm Mona. I have been a multi-asset investor for 13 years. Of course, 2020 is my unlucky 13th year. And I work for a multi-family office called Stonehage Fleming. And a family office means a family has wealth affairs which maybe have an element of complexity, or just maybe the size of their estate means that it's sensible for them to have their own investment office, and it's often more efficient for different families to club together to do this and have even more synergies. And so I've been at Stonehage Fleming for the last 2 years, and actually what's been different about my career with them is I've developed more skills in sustainable investment, which is an area I'm fascinated by.
Great, that's really interesting. That's definitely something that we will come back to later on in the discussion. And finally, can I ask Louise to introduce yourself, please?
Sure. Hi everyone, good evening. My name's Louise. I work for a large publicly listed asset manager called Man Group. Man Group probably has maybe $100 billion under management, but is a very diverse firm with a large quantitative remit on the one hand, and on the other hand, within the hedge fund portion, which is called GLG, we have a multitude of funds that sit within that platform that follow a more stock picking, less quantitative approach. Within that division itself, I work within a team of 3. I'm co-managing a European hedge fund of around €1 billion. We invest in companies below a certain market cap size within the whole European and UK space, within any sector. The niche that we sit in is that we can go long, i.e. buy a company, but we can also go short, i.e. sell shares that we don't own. That's a key aspect to the hedge fund proposition within the full investing universe, which is probably a topic we'll come on to a bit later.
That sounds great. Well, I just want to say how lucky we are to have Louise, Mona and Caroline on the panel today, because we have such a vast wealth of knowledge and different approaches to covering this topic. But maybe, given what you just said, Louise, I think, you know, investment management is an industry that sometimes rightly gets accused of using a lot of jargon. So maybe we can just go around as well and just ask everyone, you know, what is a hedge fund? What is multi-asset investing, and why should investors invest in these investment categories?
Sure. So a hedge fund is a broad term which encompasses a range of strategies which seek to exploit various inefficiencies within different market spaces. The generalization that we can create of why they're called hedge fund is that they normally have two distinctive characteristics. The first is that, as I mentioned, we can short stocks, i.e. sell shares we don't have in order to make a profit out of the share price decline. And the second key differentiator is that we can use leverage, so we can borrow money against our current invested base in order to lever up our returns. The reason we can do that is because we manage the risk via the hedging part, i.e. the ability to profit when a share goes down as well as up. So we have a more what we call hedged portfolio. So we're removing elements of risk.
That's really helpful. Thank you so much. And
sorry,
no, that's really great to hear.
It's quite complex because there are so many different types, but those are the two broad distinctions.
Yeah, absolutely. And I think it would be really helpful, perhaps, since we have two multi-asset investors on the call as well, maybe just to hear a bit how these types of strategies fit into your portfolio, but perhaps more broadly, again, what does multi-asset actually mean as a term? Maybe we can start with Mona.
Sure. There are many different asset classes, equities, which are typically more correlated to the economic cycle. Fixed income, I'm being quite basic in my description here, but fixed income refers to the debt that companies and governments have, and by investing in that debt, an investor can claim the coupon or the interest payments from that, and that tends to be more defensive, less correlated to the economic cycle. You have cash. Cash is useful to have in a portfolio because it doesn't lose value, but you can imagine that cash struggles against inflation. So when we have this idea of prices incrementally going up and up over time, you can see that cash doesn't necessarily hold its value over the longer term. There are a range of commodities, everything from coffee to gold to aluminium, and many of those things, like metals, for example, are correlated to the economic cycle. Maybe something like agriculture less so, but people often refer to gold as a diversifier or an alternative asset, because gold can offer some sort of insurance or protection for portfolios at times of market stress. And then there's a wide array of hedge funds, property, private capital. There are so many tools we can have in our toolkit as multi-asset investors, but our challenge is to create the right proportion of each of these asset classes within a portfolio in order to achieve an investor's objectives. So typically an older investor will have more conservative aspirations and want to maintain the value of their portfolio, and in that case you might be more inclined to have more cash, bonds, possibly even less directional hedge funds. But maybe someone like me, who in theory has a longer time horizon and can afford to take more risk, for someone like me, I would want to embrace equities, for example, but I'd have to have the stomach to accept the volatility that came with it. So multi-asset investing often means accepting that you can only know a little bit or some things about everything, whereas I expect Louise to have far more expertise in the European market and far more expertise on constructing that specific long-short portfolio.
That's really helpful, just to get that overview of all the different sort of building blocks, as it were, of your portfolios. And I think, Caroline, you mentioned in your intro that the portfolios that you look after are kind of constructed according to different levels of risk tolerance, as Mona was alluding to there. Maybe you could just talk to us a bit about how do you think about using those different building blocks, and how does it differ within the different portfolios that you look after?
Yeah, so Mona talked a lot about those different asset classes, and what we look at, and Mona will be the same, is the relationship between those asset classes, how they move together, and how we can combine them in the most efficient way to maximise the return for an investor. And in our portfolios, we are fully focused on risk-adjusted returns. So we are looking to maximise our Sharpe ratio. We are looking to make sure that for a unit of risk that we take, we're getting as much return as we can possibly get for that by using those different asset classes and the relationships that they have with each other. So you might find that, yes, I agree with Mona completely that actually we largely want to invest in equities simply to outpace inflation over the long run. And most of our investors also have a long time horizon, far longer than they actually think they have. But actually mixing those equities with other asset classes so that when you get a situation like we had earlier this year, where the equity markets just crash in a couple of days, that you've got something else in your portfolio that can help be resilient in those times, whether that be cash or gold or infrastructure or property or something else. And so it's that balance all the time. You're working with a balance. And we manage 3 different risk funds. So with some of those funds, with our cautious risk fund, for example, we are taking less risk. So we have fewer equities and more of those other asset classes to balance it out. With our growth fund, we are taking more risk, and those investors in that fund they're looking for a higher return, and with that they're expecting a slightly higher volatility. So they have, as Mona beautifully said, the stomach for that, and we can invest a little bit more in equities for them.
That makes sense. That's really interesting. And, you know, Caroline, you just mentioned the last few months in terms of the precipitous market declines that we saw back earlier in the year. And I thought, as a final kind of more general question to everybody, it'd be really interesting to hear about, you know, in these strange times when in the past we would have been doing these events in person. Now we're obviously doing them all in the virtual realm. Maybe you could just comment on how things have changed for you in the last few months since we all moved into home working, either from a sort of practical portfolio perspective. Maybe
Sure.
we can start with Caroline there, and we'll go around to
Yeah, I mean, the first thing that we all had to do was go immediately to work from home. So the adoption of the technology was the first challenge. And actually, my team was pretty good. There's 7 of us, and everyone rose to that challenge very quickly. I think what was challenging about it particularly was that the markets were incredibly stressed. And so it wasn't just the quick adoption of the technology so we could speak to each other easily. It was also, because we test for that. We'll all be in the same situation in our firms. You test for these situations all the time. You do these continuity plan testing. So working from home was one thing, but we had prepared for that. But the market slump is not so easy to prepare for. I've been around for a few crises now, the tech bubble and the global financial crisis. And this was different again. And of course, it's still going on. But quite a few members of my team are much younger than me. And this was their first crisis. And so you're trying to manage the people in the team as well as client expectations. And of course, the assets in the portfolio. We have quite a few direct stock positions. And so we were revisiting all of those. So it was incredibly intense the first couple of weeks of home working, reanalyzing all those companies and looking at what they were doing to get themselves through this crisis. How were they you know, not only cancelling dividends, how were they shoring up their balance sheet? Were they drawing on credit lines? Were they furloughing staff? Were they cutting bonuses? You know, what were all those companies doing? And would they still be around in a month's time? And that was our first concern. So everyone just went straight for working for that. And it actually gave us a great focus and really pulled us all together in a common cause. And of course, amidst all that, just keeping up the conversation with clients, but doing that with Zoom calls with all the advisors that we deal with, and trying to get our message across to our clients via whatever means, with different technologies, to make sure that they knew we were still looking at their portfolios.
Well, it sounds incredibly busy. And then talking about, you know, your individual stock positions, maybe that's a good segue to Louise. And I guess, given what you've just said about some part of your portfolio benefiting when prices fall, perhaps it was less of a kind of stressful period for you, but perhaps not. Let's tell us a bit about your experience of.
Well, so actually, I was actually on maternity leave when this all started. I had a baby in September, and my first day back to work was the 23rd of March, which happened to coincide with the first day of lockdown. As Caroline said, obviously in financial services, we've become used to working virtually and doing more flexible working and very tech enabled. And ultimately, I need to be able to communicate with my team. I need to be able to communicate with the companies in our portfolio. I need to be able to have my systems, but I can do it from home. So it was quite an intense start back. So our portfolio, so as I mentioned, we're running a fund. We have within the fund, across the long and the short book, between 60 and 70 names, which are companies. We run our style is to run an extremely balanced portfolio. So we're not trying to take a bet on any single theme, on any single country, on any single type of company. We've got a very diverse book. We're trying to create very steady, absolute returns every year. We're never going to be up 40%. We're never going to be down 40%. So in fact, when the market was down 40%, and we're in the mid-cap space, so smaller companies will react more aggressively to price dislocations because it's simply a supply and demand issue, and there's less stock, and therefore more money chasing less stock equals more volatile prices because they're smaller companies. It's simple as that. So our market was down around 40%, I think, at the moment when I joined back to work. Our fund was steady, so we were generating, we from peak to trough, we lost a few percent, but we were still up for the year. So this is what you pay us for. You pay us to make you a steady return in a down year and an up year. So our market was down 40, our fund was flat. So you haven't lost any money with us. The really challenging thing was that the market went through several sort of panic modes. The first was just indiscriminate selling, which puts huge pressure on our long and our short book. The second was let's figure out which companies are going to survive. So it's testing the balance sheet, how much debt they've got, whether they can weather it. And the third is the stage we're in, which we've been in now for a while, we're starting to come out of because there's more clarity, which is what does the shape of the recovery look like and how do we come out of this? And the really interesting thing, and one of the things that I love about my job, is that we're trying to think, you've got to look at the world around you, and you can analyze things from sort of a personal view as well as taking information from different sources. So for example, let's think about airlines. Everyone's trying to think about, what's going to happen to airlines, and you can read anecdotes in the newspapers. You can think about your own experience. Am I going to go on holiday? Am I not going to go on holiday? How do I judge what other people are going to do? And therefore, if I own an airline stock, do I want to own it? In fact, do I have a very negative view on that, and actually I can sell it because that's the position I'm in? Or do I say, well, you all think that everyone's going to go on holiday, and I have a really different view to that because I'm pretty sure they aren't. So you're all getting excited about EasyJet and I'm not so excited. So I can take a different view to you and make returns that way. So at times of huge stress and dislocation, when you're investing in direct equities and managing a fund, there's always a huge amount of opportunity. And that's what we are seeing at the moment because of the dislocation, because everyone's trying to figure out what's going on, and because there's so much uncertainty and unknowns. All of your toolkit of analysis, of valuation, of talking to people, figuring out the world around you really comes into play. And actually, it was a brilliant time to come back from maternity leave. Some people say, well, that must have been incredibly tough, you know, going from nothing to that. And actually, I think I'm at just as an advantage as everyone else, because no one really knows what's going on. So it's a super, super interesting time to be a direct stock picker and running a fund.
Very, very true. And it sounds like a sort of seismic period of your life in many ways. If you don't mind me pausing on just that, what was it like then, or just practically sort of thinking you were going to go back into the office and then just not being able to go back to the office? Did that give an additional layer of complexity to your sort of reaction to this market turmoil and all the things that you've been talking about?
I actually think, so one of the really difficult things about investing and stock picking is the huge amount of noise that you're normally confronted with, and not literal noise, but noise in information terms. Mm-hmm. And actually being away from the office and not being around so many people gives you more time to be, in a way, this is my experience, and people will also say the opposite, be more reflective, more focused, and slightly more removed, such that I think you can be a little bit sort of quieter in your thought process and not so reactive. Because I sit on a trading floor, I've got, you know, the traders to my right, other fund managers to my left, everyone, you know, talking, trading, etc. And it's actually lovely to sometimes not be part of that, and to actually be a little bit more quiet in the methodology. And the second thing is that in terms of, I hate the expression work-life balance, because for me work is a very important part of my life and it's something that I love very much, but let's say in office, out of office balance, you get a lot more time not commuting, a lot more time to your day, which I wouldn't have otherwise, whether that's to see my baby, do a bit of exercise. I save an hour and a half not going in and out. So actually it's made me much, you know, my job has become even more of a pleasure and has removed some of that stress. So, and we were already doing quite a lot of flexible working with my firm. They're very good about that. So I'd say overall it's been a net big positive.
Oh, that's great to hear. Well, it was really interesting to hear Louise talking about the airline industry, and obviously it's very debatable as to sort of what the outlook is for that industry, and particularly back in March, April, even so now, with are we going to Spain, are we not going to Spain, etc., on holiday. And maybe Mona, just coming back to you with the sort of COVID impact. I mean, maybe you could just highlight perhaps some of the things that you were particularly looking at, some of the things you were particularly spending time on in your portfolio at that time, whether you would ordinarily would have looked at those things, or maybe they were slightly different sets of opportunities than you would have looked at normally.
So one thing that we did that was very similar to what Louise did was, as we entered this chapter in February and March, we looked at every single investment in the portfolio and double, triple checked the investment case with a particular eye on debt. Just as Louise said, the market rewards companies that have more cash on the balance sheet and less debt. So that was something that I did that was very similar to Louise. Conversely, something that I went through this crisis that I haven't done in previous crises is that I've almost felt unnerved by how good my performance has been. And given the volatility in the market, I've sort of lived with this paranoia of, oh, it's just going to fall away, it's just going to fall away. And I think that's particularly how I feel at the moment, that many of the underlying themes in my portfolio have done very well. And it really ties in with this sustainability bent. So in a more sustainable portfolio, you typically have very little exposure to traditional energy names, very select exposure to financials and other sorts of heavy industry companies that typically have more debt and weaker balance sheets. And conversely, on the positive side, the portfolio has had a lot of technology names, particularly stay-at-home names, like Amazon, Netflix, Microsoft, Zoom, these sorts of names that facilitate us working from home. And then in October last year, we bought a fund which had some coronavirus vaccine names in the portfolio, and also had Tesla in the portfolio. So weirdly, I feel that performance has been too good, but actually, I'm probably being a bit flippant. When you look underneath the surface, it's not quite like that. There are some nuances. So sustainable investing refers to incorporating environmental, social, and governance factors. And what we've seen is that things that are related to the the social, have done particularly well. So this is the stay-at-home theme, the work from home, PPE, anything medical related has generally done really well. But interestingly, a lot of environmental exposure has lagged markets at large. And so this is the next phase I really hope that we'll go into as more governments are announcing stimulus packages that incorporate a sleeve of stimulus that's particularly focused on the green economy. So this is the sort of day-to-day news that I'm really focused on. And yes, we really want to see the names in our portfolio that relate not just to clean energy, but also to water, pollution, nutrition. That side of things is yet to perform.
Okay, that's really interesting. I really want to come back to that theme of sustainability, but in the meantime, I just given the sort of overarching topic here, Mona, you'd mentioned that you sometimes invest in funds. Sometimes you were looking at individual companies, and obviously Louise has talked about individual companies. Caroline, maybe you could just tell us a bit about within your own portfolios. To what extent are you mainly investing in funds? To what extent are you investing directly in whether it might be a stock or a bond? And this is a rather large topic, but at a high level, how do you think differently about those two types of investing? What do you enjoy or perhaps or find most interesting about each?
Yeah, so we tend to invest directly where we can. Mm-hmm. So for equity exposure, we take some direct equity positions, but we also use some derivatives. And we've been doing that since we launched our funds in 2007, taking advantage of what were new rules, UCITS 3 at the time, that allowed you to take almost the whole of your portfolio exposure through derivatives. So at the start of 2007, we were using total return swaps, and actually we've moved since the credit crisis finished more to using futures and options. And so the judicious use of options has helped us because we've had, at the start of this year, we had some of our equity exposure in call options, which of course the nature of the call option has been that if the market falls, you lose simply only your premium. And that was very defensive for us in March or late February as well. But of course you can't run that strategy forever, because if you want to then take your profits and rebuy those options, they are expensive with increased market volatility. So we run that in a small part of the portfolio, but where we can't buy direct assets, things like infrastructure, for example, property, we would look for a third party fund to do that through. And over the years, we've tended to prefer closed-ended funds rather than open-ended for those sorts of assets. I think the regulator is also coming round to that idea rather more slowly. But when you're trading large, immobile assets that are difficult to trade, then an open-ended fund is not necessarily the best place for those. And there's been some fairly high-profile casualties in the last few years.
Maybe so, our audience might not know what is meant by open-ended versus closed-ended fund.
So an open-ended fund is a fund that can grow forever and get bigger in size. The more people who buy shares in that fund, the bigger it will get. So Louise saying she's running £1 billion hedge fund could get bigger as more people buy in. But a closed-ended fund, and that would be perfectly appropriate because she has the whole European marketplace at her disposal. But a closed-ended fund would restrict its asset base to a fixed number. It would have a fixed number of shares. So if you wanted to buy into that fund, you would have to find someone to sell to you. And that means that the asset manager knows exactly how much he's got or she's got to run, and then can buy those properties or infrastructure projects accordingly. It works very well with illiquid investments where they are difficult to buy and sell. So it works well with very small companies as well, where liquidity is difficult in the market, but particularly with real assets, property and infrastructure. So if you wanted to buy shares in a property fund and it was an open-ended fund, the manager would have to go and buy another property. Conversely, if you wanted to sell those shares, the manager would have to sell a property, and that becomes really difficult in a tight market, and particularly when those assets themselves are quite lumpy, they're quite big sizes. So a closed-ended fund works really well for those type of assets, and that's what we prefer. There are nuances to that as well, and there's lots of different pricing mechanisms to take into consideration, but that's what we look at. For commodities, we can use derivatives. We would look to ETFs, exchange traded funds. Cash is just hard to get any sort of return on, but for government bonds, we would go directly, sometimes into the auctions. And for some broader corporate fixed interest, we can't do everything. And Mona would understand when I say this, you can't cover everything in the depth you need. And we can't do all the equity analysis that we're doing. And also with our smallish team, do lots of corporate bond analysis. So we would outsource that to a fund manager as well.
Well, it sounds like you already do quite a lot, so it's very impressive. But we're starting to get some questions coming in now from the audience, and so we're about halfway through. I can't believe how quickly it's going. So do feel free to submit your questions, and I'll just try to weave them into the general kind of Q&A. And I was actually going to move on to asking our panelists a little bit more about their personal journey and how they got into investing, because I know that's often a topic of interest. But just to start off, I think a lot of people often think that investing is a career where you have to have studied maths or engineering or another STEM subject. So maybe just as a sort of segue into this strand, did anybody on the panel not study a STEM subject? I certainly didn't. So Louise, it'd be great to hear what. Well, let's just go through it. Let's just quickly go around and hear what everybody studied at uni.
Shall I kick off?
Sure.
So I read classics. I did it at Oxford, which is very much not a economics degree, but I loved it nonetheless. To be fair, it's like complex and highly analytical. Investing is an art and a science. Being a good stock picker, like there's many different facets to that. Key is an analytical ability and an inquisitive mind. I think those are the two things that stand out the most for me. It's a huge misconception that you need to have studied maths, physics, or economics. There are very specific roles where you can have a PhD in maths and be an amazing quant, and there's a whole industry built around developing quantitative investment strategies, but there's a whole market that has nothing to do with that and is much more qualitative, with obviously the quantitative numeracy, but it's not PhD level mathematical ability that's needed there.
Caroline, how about you? Sounds like you and Mona were more technical.
Yeah, I studied engineering, civil engineering. I spent a couple of years working on a building site as well after I graduated. And I came late into investment management. I was 27 when I joined the industry. So I tried a few other things first, including working on a building site. And I agree with Louise completely. I think the key skills are curiosity and having an open mind. A base level of maths is needed, but it is a base level. A degree is not a necessity in that regard. And I think one of the things that is so important with a team is to have diversity in the team. And in this case, in this particular discussion, diversity of background. Everyone in my team has actually done something different. We've got an economist, but then we've also got people who've done many different other subjects. And I think having that ability to discuss from a wide range of perspectives is what's important, rather than having 5 economists in a team. I think that would be maybe encourage too many people to think the same.
I completely agree. And Mona, we'd love to hear from you as well. What did you study? And then maybe we can broaden it out and hear a bit more about your journey. How did you get into investing broadly?
I did economics and politics, but now with hindsight, I think I shouldn't have done that, and I should have done drama or Spanish, or I should have done what I wanted, because actually the best analyst I've ever hired did history of art, and I really think you can get away with GCSE maths. I actually think analysts coming into this industry as juniors probably have an advantage if they're pretty proficient at Excel as well. Being able to combine a strong GCSE maths with strong Excel skills, I think can really set you up. But as Louise said, I think curiosity is the key thing. Curiosity, a willingness to challenge others, and also to enjoy being challenged yourself. And I like that. And I guess my perception of investment management versus other industries is, I do think that this industry rewards all-rounders maybe more than others do. My sense from talking to people who work in other industries is that skill sets tend to be more biased in particular ways. But if you're an all-rounder, I think investment management is a good fit.
I totally agree with that. And I studied English literature at university, which probably couldn't be further from the perception, perhaps a bit in the same way as the classics. And I never found it any impediment at all. In fact, I found it, reading lots of things and sort of distilling the key points has been pretty useful along the way. But one of our audience members is just asking whether there's any particular qualifications. I mean, maybe some of us, you know, irrespective of our degree, might have done other qualifications along the way that we found useful. I think learning to do Excel is really a good tip, and you can learn that on the web, so people could potentially get up to speed on that in preparation. But what other qualifications have people found really helpful, if any?
So when I started in the city, just to broaden it out, after I left university, I joined a buy-side investment management firm as an analyst, and I looked at global consumer stocks only. And after that, I moved to GLG to run a generalist hedge fund. I did my basic investment management certificate, which is called the IMC. It's a very nice introduction to all asset classes and kind of within each asset class, key metrics and concepts that you need. I mean, I'd highly recommend that as a starting point. You can do it on your own. I did it in a couple of weeks. I then had to do multiple other regulatory requirements, and then I also did all my CFA 1, 2, and 3 to become a CFA charter holder. I hugely benefited from it. Gave me more depth and understanding to theory and concepts, especially through asset classes, given I'm equity only, so I have a better understanding of economics, etc. But I came from a non-financial background, so for me all of that was very valuable. All of these qualifications you can do on your own. You can do distance learning, you can do flexibly, and then there's multiple courses you can do to broaden Excel skills and other, whether you want to do PowerPoint or, and there's so much online now as well. So yeah, that's my
just given what you just said about coming from a non-traditional background, could you just tell us, how did you actually break? I mean, the industry has a reputation of being hard to get into, although I think it's crying out for people with different backgrounds. But how did you actually break into investing? How did you get that first job? Well, I guess it's still your job at GLG.
Well, so my first job was in Newton Investment Management, okay. Where I was an analyst. I applied. I did a lot of applications. I did a lot of interviews. I did a lot of online tests. I did a lot of talking to people and meeting people and saying, hey, can I have a coffee? Can I talk to you? To sort of broaden my understanding of different areas, broaden my knowledge, be able to have more in-depth conversations. I did a lot of reading, read, whether it's an interesting book about Amazon or gold or you know, an investment manager that's done well, or you know, anything that you can use to sort of have breadth and depth and just an interest. And then I was actually about to join the graduate program at Barclays Capital and do their broad rotation, and then the Newton offer came up, and I much preferred to be within a smaller buy side. We call them buy side and sell side. It's sort of broad terminology, but the sell side are basically the larger banks with big graduate schemes who sell research to other firms like buy side. So I was just, you know, keep firing, and it's rewarded.
I absolutely agree. And if anyone wants any ideas for things to read, there's lots of material on the GAIN website at www.gainuk.org, which I'm sure everyone's visited to get the details for this talk. We've got lots of books and podcast recommendations there. But Mona and Caroline, did you have any other, would you endorse doing the CFA, or did you do any other qualifications?
Yeah, I mean, I would endorse the CFA as well. That's certainly the route that I took. Similarly, like Louise, via the IMC as a starter. And it's the route that we support in our business. So all the analysts in our team, we encourage them to take that route. I think it gives everyone a lot of breadth and depth as well. And it secures a level of knowledge, which I think then sets you up. I actually think, because I got my charter about 12 years ago now, but I think now it's become much more of a standard for people to hit in this country. It was a little bit more rare when I got it, but actually now it seems that most people are accepting that that's the route to go, and a lot of companies are looking for that at the second or third job move that you look to do. So I think that's definitely the right route forward. I would add to the list of things that are useful, programming skills. I think for certain jobs, programming skills are going to become quite useful, whether that be VBA within Excel, whether that be something like Python or R. Those are becoming increasingly desirable traits, characteristics that people can have. It's certainly on the list of characteristics we look for in our analysts now, whether it's an interest in that, or it's an existing skill, or it's a willingness to learn, because again, there's lots of online courses. But quite simply, you get more out of Excel if you can do a bit of VBA programming, and you can extend that further again for certain analytical jobs. Programming skills are quite useful. And if I can add just one more thing on getting into the industry, internships. And I know that they feel like they're quite hard sometimes, but businesses like ours, which are relatively small, offer internships for people. We've had 2 interns this summer. I've got one finishing this week and another one starting next week. And actually, I think an internship is a really great introduction, because at least even if you don't like it, at least you've learned what you don't want to do. And I think when you're an undergraduate, trying an internship each summer gives you 2 opportunities at least to have a go at something and try, whether it be hedge funds or wealth management or investment banking. And that would be a leverage off every contact you've got opportunity. Whether that, it doesn't really matter. There are some available for general applications, of course they are. But if you have a contact and you have someone you can call for a coffee and you know, get even a 2-week internship, it just helps you understand what you like to do. And that helps career choices.
You know, for those who may not have access to as many contacts, there's also an organisation called Investment 2020 that offers internships for application from across the industry as well as sort of individual firms that may offer internships. But it's worth going to the websites of all the major players, because many of them do advertise, although obviously for this summer it might be a bit late, but thinking ahead to next summer. Mona, what about you? What would be your top tips for skills, qualifications, things that people might be a tough job market at the moment if people aren't getting the job that they want straight away? What can they be doing to improve their chances down the line?
Yeah, great question. So I did the CFA. I recommend doing it as the fastest route to achieve credibility as someone who is more junior, and I think it's also a very rare qualification in that it is global. So if you move to Singapore at some later date, it is just as valuable there as it is in London. I think on this call we've focused quite a lot on the technical skills of being an investor, and I don't want us to scare people by doing that, because there's also a warm welcome to people who can understand investments very well, that communicate them in a digestible, bite-sized way to people who are maybe less familiar with investments at a technical level. There's definitely a role, many roles for people who have excellent communication skills, but also quite technical brains as well, and who maybe don't want to dig deep and do the Excel macros, etc., feel less comfortable with that. So really, I'd give the same advice that I gave in the last game call I did, which is pick a sector or a subsector that interests you, whether it's luxury goods or airlines or whatever it is, and do lots of reading on your own and write your own buy or sell case. Write up the risks to your investment case, what might go wrong, and why you have such high conviction in your idea. And once you've written that up, then have a look at LinkedIn, see who's in your network, and use that as a tool to go and have coffees with people. And I say that because when a random person approaches me for coffee, it's okay. But I often think, oh great, I'm going to have the same conversation that maybe I've had with 30 or 40 other people at that undergrad level. But if that person came to me and said, hey, I've worked hard on my own to do this luxury goods sector deep dive, I'd be fascinated to have a conversation with them, and I'd really be willing to give up an hour or two. So that's my top tip.
I think that's really good advice. And I actually remember after the last financial crisis, in my old job, I was recruiting, and I had an application from somebody who hadn't been able to get a job. He was actually working in a call center, but in his evenings, he was doing the CFA level 1 on his own. And I just thought that just shows such initiative. So taking initiative is so important, and it just demonstrates so much commitment to the industry, and so much drive that employers will really value greatly. Now we're running out of time.
Sorry, can I just add one thing that I just remembered? You can run phantom portfolios, like on various stocks and shares dealing websites. You can create phantom portfolios, i.e. no real money needed. It just tracks your performance. And it's something that when we interview people, like quite a few people have been able to demonstrate, I was so interested in Amazon and Ocado, and I had them in my phantom portfolio, and then they can actually demonstrate like how they've kind of constructed something or put it together, even if it's 4 stocks, that demonstrates a worldview and sort of incremental active interest. Just to add to that, no, it's like not live, no money required. It's purely tracking a price virtually, phantom.
Where would people be able to do that, Louise? Do you know?
Well, I can't think now, because when I did it, which was now 12 years ago or something, I can't think. But if you were to just Google phantom equity portfolio, all of the trading websites will have them, I'm sure. Or you even just make your own Excel and take the stock prices the day that you did the reading off Google Finance and just plug them in, and then you can at least say that day I knew the price was this.
I think there's one on the Hargreaves Lansdown website, and I think there might be one on the LSE website as well. And apologies now, I think my mother's leaving me a message on the answer phone in the background, so the only person who uses the landline. Now, please do keep the questions coming. We've had a few. I tried to answer the ones that we've had so far, but we've got about 10 minutes left on the clock. So if you've got a question, now's the time to pose it. And in the meantime, I really want to come back to something that Mona mentioned earlier, which was your particular interest in sustainable investment. And maybe you could just tell us a little bit more about that. What does it mean? And in particular, perhaps bringing it back to the topic of hedge funds and multi-asset So how do you incorporate sustainability thinking at the portfolio level, and how does that compare to sort of perhaps how you might think about an individual stock or an individual company management, and how they behave and what they prioritize?
Thank you. That's a great question. I will try to keep it shorter, and then if people come back with other questions of areas they want me to dig into, that would be helpful. So just working through the asset classes, cash for us is kind of neither here nor there. Bonds are really interesting, and we've had many arguments on the desk about bonds, specifically government bonds, because nowhere across the investment paradigm is this idea of something being all good or all bad so false. There are very few governments that are all good or all bad, and obviously the US government is US government debt is the largest, the most liquid, etc. And so we had some painful discussions about whether US government debt was investable. In the end, we decided it was, because there was more good than bad. But I would say that was an area where I found it really hard to check my biases. We really like green bonds, which are a really unique part of the fixed income complex. So every bond has various legal documents attached to it. But in order for something to be a green bond, there's specific wording in the legal documents that says this bond must be used for XYZ purpose. And that purpose is for wind farms or for data centers that run on renewable energy. There's some very defined environmental purpose that we like. Hedge funds so far have proved to be a really tricky area. I'll use a long short equity fund as the most as a key example. So you can go long a stock. You can buy a stock because you think that it's a very sustainable company. So then do you short a stock because it's unsustainable? And just because it's unsustainable, does it necessarily mean that the share price is going to go down? It's tricky. And so if you use an example like Coca-Cola, so we have met investors that have shorted Coca-Cola based on the high sugar content in their drinks and the link to obesity. But Coca-Cola is such a massive company. So unless you're a hedge fund with billions and billions of dollars, it's very difficult to go up against that management team, and you'd have to possibly be really activist, which means being really loud and noisy in the press, typically to give Coca-Cola a really bad rap. But how many of us don't know that when we drink this sickly sweet brown liquid, it's bad for us? We all know that, and many of us drink it anyway. So hedge funds are really tricky, but we haven't lost faith. We think there will be opportunities there. Gold is difficult for us to invest in because of the environmental degradation. So what's left? Well, there are a few things, but for me, the most interesting thing that's left is catastrophe bonds. So catastrophe bonds relate to hurricanes, flooding, things like that. And in my view, and I'm probably quite lonely in my view, in a world of increased climate change, we're going to have more weather risks, so more flooding, more hurricanes, etc., etc. And I think one of the reasons why society struggles to think about the risk of rising sea levels is because society can't price it properly. But if you can make climate change risk or insurance policies or catastrophe bonds more common, then in theory we'll help society price those risks in a better way and understand them better. And of course, hurricane risk and flooding risk is completely or generally uncorrelated to market risk and economic risk. So that's the key area I'm looking at in the alternatives bit.
That's really interesting. And you talked about the sort of problematic nature of integrating sustainability thinking into going long or short of stock. Since we're lucky to have a long short equity investor on the call, maybe Louise, could you just talk to us about how you might factor those types of considerations into your thinking?
So we have an internal analytics tool that has been developed in response because there's a lot of investor focus on sustainable ESG investing. That analytical tool gives us a scorecard. We can cross-reference the companies that we want to invest in our fund, be that long or short. We can cross-reference that with that scorecard that it comes up. We use it as a part of the whole picture rather than the picture itself. And we increasingly integrate that into our process. We don't have voids. We don't have currently pressure to have voids in sectors within our fund, although naturally we're not investing in companies like mining stocks. Tobacco stocks are too large for us. Large consumer goods companies with alcohol, etc. I'm sort of, this is coming more from the ESG focus. We don't naturally aren't really in our space. So the things that flag up for us are much more around the S and the G. And yeah, we have a scorecard and we rank the companies in our fund and look at what exposure, but it doesn't dictate our investment decision.
That's really helpful. Now I've got a specific question for you, Louise. Somebody's asking, do you think working in hedge funds requires a different skill set or personality, interestingly, versus long-only equity investing?
Well, I've done both, so I'm not sure what that says in answer to the question.
You're involved.
I think if you're, it takes a certain mindset to be able to think about shorting a company, because naturally we are more optimistic than pessimistic, which is also reflected in the fact that over time the market does tend to go up rather than down over the long time horizons that I'm talking about. And you fight a larger tide of money which is naturally seeking to be investing in companies going long. So shorting stock and being a shorter is difficult. You have to be much more skeptical than maybe you would normally. For me, my personal belief is that if you can be analytical and seek to find returns in companies, you should be able to do that on the upside and the downside, i.e. from stocks going up and down. My colleague who started our fund, incredibly successful, been in it for 20 years. He has exactly 50% of his track record in top quartile returns in the long only space and 50% of his career generating very good returns in the long short space. So an answer, yes and no.
You can be good at both. Great. Well, I hope you don't mind if we just run over by a few minutes, because there's one more question I want to put to you all, and then I have a question for everyone. So somebody's asked, what does career progression look like in our jobs? So maybe Caroline, I can put that last question to you. And then as a finale, I just like to ask everybody to give their number one piece of advice, either a piece of advice that you've been given or your number one piece of advice for the audience. So then we'll go Caroline, Mona and Louise. But first of all, if we could just talk a bit about career progression, Caroline, that would be really helpful.
Yeah, sure. And there was also a question on financial planning and wealth management, which I can quickly pick up at the same time, which was what's the difference between them? And the difference is wealth management tends to have much more of an investment focus. Financial planning is much more focused on ensuring that tax affairs and other financial planning considerations are taken into account. The wealth management business nearly always has financial planners in it. It's just that I work in a wealth management business, but I'm not a financial planner. I do the investment management. So that it is a career. Financial planning is a career that you can do if you like talking to clients and working out what they would like to do with their money and how they need to plan for their retirement and paying for education and leaving legacies. That's financial planning. Wealth management is typically managing that person's wealth to achieve those goals. And that's just a quick introduction. In terms of career progression, I mean, it's a massive question. That it's very, very open. Career progression clearly requires you to do a decent job and to find something you love that you want to progress in. And it's likely to require you to get extra qualifications. Some professional qualifications are almost essential these days. But I think what everyone needs to recognise is that if you go down the route of, say, an analyst, a career progression from an analyst isn't necessarily becoming a fund manager. There are people who are career analysts who are exceptionally good at that job, and you could stay in that job and progress up through that. So in the role I'm in, I have analysts in my team who won't go on and be fund managers, and that's absolutely fine. They're just exceptionally good at what they do. Some people have got more of a personality, or they're more happy making decisions, and maybe they would go down the portfolio manager route. Other people, depending on how resilient you are for making those decisions, you know, as a fund manager, there are some difficult times when the markets are bad, and panicking is not a good trait. So if you're liable to not sleep at night as well, then you're not going to enjoy your job as much. So it's about understanding yourself and where you think you can go. And of course, you can career progress by moving companies, or if you're lucky like I've been, the company develops with you, and I've been at the same company for 20 years. But I didn't start out as a portfolio manager. I started out doing a technical role actually on the financial planning side, and worked out very quickly that I did not want to see clients all day, every day. So that was like my internship, if you like. Learned what I didn't like, and then I switched sides. I went down the asset management side, but grew with the company. Other people have moved companies to get that progression. So it's an open-ended question. It's what you make of it, really.
Oh, that's so helpful, though, just to hear the range of different kind of scenarios. And then I guess just as a wrap, if you could just tell us your top tips,
yes.
and then we'll go Caroline, Mona and Louise, and then we'll call it a wrap.
I think one of the best bits of advice someone gave me was that it's okay to say no. So, and as I've got older, and I'm definitely older than my co-panelists here, I've realised that's actually okay to say no to opportunities, not just investment opportunities, which I have to say no to a lot because there's a lot of them and some of them are not great for our clients, but other things in life as well. That it's okay to put yourself first occasionally, and to say no to things that might end up cutting across other things that you want to achieve. So set your targets, set your goals, and set out to achieve those. And sometimes you need to say no to some other things that come up.
That's good. Mona?
So my advice that's specifically targeted to the audience on this call is there are a lot of different jobs out there that you can't really practice from home. You can't set fire to buildings and then get a giant hose and put the fire out. You can't go into space until you've joined NASA. You can't defend a criminal until you've got your bar exam. But with investment management, you can start tonight. And there are lots of people who have small portfolios that they trade at home who do all manner of different jobs. So my best advice is, if you really are interested in this, start tonight. Start reading something from the gain list. Start making a short list of 2 or 3 sectors you want to work on. Start thinking about what your base characteristics are going to be for your phantom portfolio. Will it be growthy, more income orientated? You can do this now without having an internship. I'm absolutely sure.
That's really helpful, thanks. And Louise?
Yeah, I think that's very good advice. My advice is just going to be read, and it doesn't have to be difficult, complex books. It can be journalistic investigations into, you know, CEOs. There's a brilliant podcast called American Scandal that I've just been listening to, one of the series of which is about the Enron collapse. Anything. Yeah, read.
Sounds good. Well, hopefully we'll all enjoy that. And just for my personal 2 cents, I would say I don't think anybody on the panel, including me, sort of got straight into the job that they're doing now. We all had to go through other things, whether it was as extreme as working on a construction site in Caroline's case. So, you know, if you don't succeed at first, keep going. You will be rejected. But, you know, if you keep going, the only way to ensure that you're rejected permanently is to stop trying. So do keep going. And, you know, with all of these resources, and if you can get some experience, if you can do your own research, you know, you're just going to increase the chances of getting there in the end exponentially. But with that, I'd just like to thank, I think everybody who joined is still on, so thank you all for staying with us throughout this hour and 10 minutes. So we've run over, apologies for that. And I'd just like to thank the panelists so much. It's been a real pleasure to meet you all, to talk to you, to have the privilege of learning about your lives and your careers and experiences. So thanks so much to everyone, and have a great evening.
Thank you for having us.
Thanks. All the best.
Bye.
Bye.